Hello, it's Paul McFadden here again with both Paul Rawson and Steve Hand. And today we're going to talk a bit more about different forms of funding and accessing money. So, one of the things I always talk about when it comes to all things investing and accessing money is that you've got to look at all the various options that you've got, because one of the creative things you need to do, because if you might start out in property with your own money, what do you do when you put that money to work? Then you want to look at other ways and how you can leverage access to funding. And one of those ways might be perfectly suited for you. Now, we just spoke about this before we started recording this podcast, and I'm asking all different things because there's different terminology, especially when it comes to finance. Second home lending, secured charge lending, cross collateral funding. Like there's all these different things. I want to break it down so that you can start to see whether you decide to use it or not, that you've got access to a lot more money than you first thought. So, can we have a little chat about second charge lending and the different terminology and why it's important and what you could use it actually for?
So we'll start with all the various names, shall we? Yeah.
Yes.
So we've got secured loan,
Secured loans.
second charge
Yeah.
lending,
Cross collateral.
homeowner loans, second mortgages, and there's probably one or two others, I imagine. But this is essentially a mortgage that sits on top of your main mortgage. So you can put them on buy-to-lets, but most people would obtain it against their main residence. And it's a great way of solving maybe borrowing issues for people, but also it can actually be the most economical way to extract money out of someone's main residence.
So this is someone accessing, I guess, the equity in their own home, potentially sometimes more.
Correct, yeah. So a traditional mortgage, especially if you're remortgaging, would maybe go to 90%. Some lenders have got various reasons that they will and won't let you do that lending for. Whereas secured loans, I mean, it was quite astonishing to me even to find out that on paper they can go to 140% of the house value. Now, before we carry on, this is not us saying everyone go and get 140%. The usual warnings should be applied, such as your home is at risk, and if you don't keep up repayments, you can lose your home, and all that is very important. But in theory, yeah, you can actually go above the value of your house. Now, why would that be a good thing? Maybe you're drowning in debt and you need to consolidate debt. That's one of the main reasons that people use them. And then secondly, it's if mainstream lenders, because you've got yourself into a bit of a mess credit history-wise, and are not willing to entertain you and help you out, these things are a lot more tolerable for people who are in that situation. And again, it might be the difference between them just carrying on going into the deep, dark hole, or getting their heads above water and at least treading water for a period of time till maybe, they get a better wage or whatever it is they need to do to get their lives back on track. So that's the downside of it. The more depressing reasons maybe why people turn to these, but other things, Steve.
Well, one thing that's just come to mind is home improvements. That is a big area why people take out secured loans or second charges. Just for easy maths, let's say someone's house is worth 100,000 and the mortgage company will go up to somewhere between 80 and 90,000, and they want to build a double-story extension. I know you wouldn't normally do that on a house so low value, but let's just go with it. You can borrow, like Paul says, up to 140%, get your extension done, lift the value above that 140,000, and then remortgage to clear it off and have one mortgage again. Yeah. If your income allows, but they're a little bit more flexible with their affordability. So typically high street lenders will lend 4.5 times income, sometimes maybe a bit 5. More. Yeah. But the secured loans go up to 6 times income. So again, you've got that flexibility to borrow to get your extension done and then to recapitalise and clear off the debt.
And I guess this can work for investors as well. So like a similar situation, I share the same story all the time. When I get started in property not having money, there's a lot of investors, similar situation. And when I bought my first residential home, so we put down a 5% deposit. So we'd already maxed out. So if we use that as an example, let's just go with round numbers, 100K value, we've got 95K mortgage on it. I find a cracking deal that I need like 40 grand. At £40,000, my acquisition cost, deposit, refurb, legals, all the associated purchasing costs, and I know that I can flip that, and I'm going to make a 50% cash on cash return. So I invest 40, I'm going to make 20 grand net profit. That's all my forecast in terms of doing my due diligence, done my numbers. And of course, I can go out there and look for joint venture partners, or potentially I could contact a broker such as Express, and they can look at my affordability and go, okay, we can actually give you up to 140% loan to value against your home. You know, it's worth 100, means you can borrow that 40K in effect
Yeah.
to allow you to go and invest that in that project, as long as you can cover the cost of the borrowed money. And I already know that by leveraging my own home and equity there, I could go and put that into a deal that I know that I can flip. It's going to make me 20K profit, pay back the mortgage later on. And this is another thing as well. A lot of people start to get a bit concerned about borrowing against their own home or getting into negative equity in this example. But you shouldn't do if you're confident in your number and you've done your due diligence in the deal and you know the profit's going to be made.
Yep.
Because it's just using money. This is the thing that messes with my head. It's like you're just plucking money out of thin air. Of course you're not. There's a formula that lenders look at it, but it's like, what? I thought I had no money, access to nothing, but I've actually got access to money and I can put it into something that can make a profit. So when we look at this here in terms of when people should use it or not, I think we should go back to look at fundamentals and just talk about generally equity release or accessing equity in your own home. Why? Because a lot of people have got this kind of mindset that they've got to pay down the mortgage, haven't they?
Yeah.
I mean, it's kind of what happens, isn't it? It's like the dream is to get on the property ladder, and then as soon as you start to, move to your next bigger home, you get to a certain point where it's drilled into you that, the pinnacle of success is to be mortgage free, have paid down your mortgage. So a lot of people have a bit of apprehension about, you know, even remortgaging to a higher loan to value or taking on a home improvements loan or second charge lending because it's like, shit, it's debt on my own home.
Yeah.
So I guess it's all dependent on what you're borrowing that money for. Because
Yeah.
if you're borrowing that money to then go and be wasteful of it,
Yeah.
then it's going to be hard to generate income to then repay that loan.
That's it. If you're borrowing it to just upgrade your lifestyle and go on more holidays or whatever, or buy nicer clothes or whatever it may be, then maybe it's not such a great thing. But investing it in the right projects, then for sure. I mean, even we get conditioned, don't we? Like I was conditioned to think I'll clear my mortgage off in my 40s because my old man did, thinking that was the sort of barometer of success. And then it takes time to sort of go against that conditioning, doesn't it? And it, in fact, coming to Protégé for a week really impacted me in a positive way. In that, wow, leverage. I can use this word leverage to accelerate growth. So let's forget about paying down the mortgage. Let's consider increasing the level of assets that I've got, or getting into more projects, or whatever it may be. Yeah. So it takes time, and sometimes you do have to get away from your own sort of goldfish bowl, educate yourself, and think, right, wow, I've just opened a whole new world of possibility here.
Yeah. When I look at accessing finance or funding, I'm looking at the rates. So, I might look at, well, I've got this JV partner, he's interested in putting money in at this percentage. I've got this person interested, I've got this, second charge lending option at this percentage. And once you are aware at what borrowing you can get at what percentage, the project you're about to get in on, whatever deal, does that produce a much higher return? So if you look at it from that perspective, then you should be confident in yourself to go and borrow that money.
Yeah.
And who better to borrow than from your own home? Because you don't need to have JB partners, you don't need anyone else, although there's merit to having those. But it means that from the cost of borrowing, if it's going to be X, you want to make sure Y is significantly more. And this is where, if you can just work on that mindset shift about the equity in your own home or putting on a second chart or second loan against your home, but it's for the pursuit of making more money and building wealth and being able to leverage. And I always talk about that. If you're able to leverage other people's money as well as other people's time. So you leverage other people's time in the game of property using brokers, using solicitors, using builders, using an accountant, doing things what other people can do to allow you to focus on the most important things, which is finding the deals or raising more funds. And then when we're talking about leveraging other people's money, that's why having a great broker, so you can leverage different forms of lending. And as soon as you start to explore and look at that, now you have more confidence. You know that when a deal comes up, because everyone does it back to front, they find the deal. They don't know how to finance it. Why don't at the beginning they start laying some foundations by speaking to a great broker, looking at options, tell me more about this second charge funding or secured home lending and all, so they can see what options are available. So when a deal lands, they're ready to jump on it.
Yeah, second charge mindset can be a bit like the bridging. It's expensive, and yeah, of course, because they're sitting second in line to get the money back, the rates are higher, the fees are higher. But it's not all just about what we alluded to earlier about fixing people's credit problems, or they've not got they need higher income multiples, or whatever the case may be. Mathematically, it can be the best solution. So um, look at someone who maybe got a 5-year fixed rate a couple of years ago at less than 1%. So the other option is that we just take that mortgage and we get a further advance with a lender. That might be the best solution. Or we move it to another lender, but then the problems can start being, well, you've got an early repayment charge to move it, and the whole amount now is going to go from maybe less than 1% to currently 4.5, maybe edging towards 5, depending on your circumstances and how high you go against the loan to value. Whereas a second charge can sit on top, so you get to keep your cheapest chips deal from a couple of years ago, and you just pay a higher rate on the bit that you're taking. So of course, it's a regulated form of borrowing. People have got to be comfortable with the risk. Obviously, the lender's got to agree to the purpose of use and things like that, and it's got to be affordable. But again, people just go into, I'm not doing it that way because the rate's higher. But maths can prove it's actually the cheapest way to extract that. And coming back to what you're just saying is, and if the return is far greater than the cost, then it's another way of opening up into the property game.
Yeah. I've seen a few people have found themselves in a situation as well where they've became recently self-employed and they don't have enough self-employed books to be able to go with the lender they're currently with.
Yeah.
So that's a perfect opportunity for them to access it as well.
Yeah, you'll still need about a year's accounts, but most first charge lenders are asking for 2 or 3 years. So again, there's maybe 1 or 2 who'll go for just the 1 years for us to extract the equity. But again, this is the point behind what we've done at Express. We don't just have first charge advisors. And what we certainly don't have, because I'm adamant and he's adamant we'll never go down this route, is people who say, yeah, I'm a bridging and development advisor and I'm a first charge advisor on resi and buy-to-let and portfolio landlords, and I'm going to do second charge. You can't do that. Yeah. And I've had this thought from years ago when you say to IFAs, what do you do? And they go, oh, I do life cover, I do PHI, I do inheritance tax planning, I write wills, I do investments, yeah, and pensions. And you think, forget it, yeah. You know a little bit about a lot of things. And we've always applied that to Express. So when people come to us say, we want to raise finance for property investment, it's not an automatic that it's a further advance, but we'll look at that. It's not automatic that it will be a second charge, but we'll look at that, and then we compare and contrast and go back to them and say, right, okay, usual warnings that the FCA insists that we put out, and of course we do. But mathematically, this route looks like that, this route looks like that, which suits you? What are you most comfortable with? And that's to our strength, because again, our clients aren't having to deal with 4 different brokers to get different answers. We've created the specialised team in each area to be able to cover that. How do I get my hands on equity?
Yeah. And that's always going to give the client more confidence, isn't it? That when they're speaking to a broker such as Express, that have got that access to specialist lenders to look at someone, in their own situation and go, well, you could go down this route. Maybe you should consider this here. You've got options. And this is why I always recommend is the first thing anyone should do when they're looking to go out there and borrow and lend money is to initiate that first conversation with a broker.
Yeah.
Because once you start to discuss your personal circumstances, situation, where you're at just now and where you're looking to go, you're going to start seeing you've got access to a lot more funds than you probably first thought. And off the back of that, it just gives, I can't stress this enough, confidence. Once you realise that you've got some financial support there that you can access, you're going to see you start putting more offers in for properties. You're going to start seeing that you're going out there networking more and really play this game up properly, because you know that you've got some funding behind you. So when we're talking about some creative ways of financing here, I can probably assure it that a lot of people, listening or watching this podcast just now hadn't even thought about that. I know I never knew about that in the early days, my own property journey as well, but it's very relevant. And again, I can't stress this enough. My thought on borrowing money is if you get it at this rate, as long as that's investing into something that's going to give you a significantly higher rate, then you should be considering it. It might not be the best option. It might be the only option, or it might be something else to consider along with other options too. But in the game of finance, it's getting in touch with that broker, having a look and see what your circumstances is, what you can get access to. And again, I stress this for anyone, whether it's a homeowner in your own home, or you've got a portfolio as well, and whatever it may be, you don't need to borrow against it. But wouldn't it make sense to have that conversation with the broker to see what you've got access to and what the tentative rates are, so that when a deal comes up, you don't need to go out there and try and find finance elsewhere. You can utilize what you've already built to then get your start. So again, it's having options to see what you can do and make that move when you start seeing some property deals. So it's a bit of a shorter podcast. Again, if anyone's interested in exploring and finding out more, head over to expressmortgages.co.uk. I'll link off to the website in the show notes as well, so you can go along there, have a chat with the team of experts over there to explore and see what options you might have. And again, if any questions, just pop them in the comments below. We'll be happy to go in there and respond and answer any of those as well. And as always, make sure you're subscribed to the channel too, because you guys subscribing, it gives us so much more confidence that you're enjoying, you're liking the content, and wants us to then share more stuff that's going to help you on your journey going forward as well. So all the best, and bye for now.